Most people think the big story is the stock market making new highs. I don't. When everyone stares at the screen that loudly, I start looking at what is moving quietly underneath it. And right now, the quiet move is more important than the cheer around stocks, because the thing being repriced is not just companies, it is money itself. If you want to stay close to the signals that usually matter before the crowd sees them, stay with me, because this shift is hiding in plain sight. I've been through enough cycles to know that the loudest story is usually not the deepest one. A stock index can hit a record and still tell you very little about what is really happening underneath the system. In the first half of 2025, the so-called Magnificent Seven made up about 31.5% of the S&P 500, yet they produced only a small slice of the index's gain. That matters. It means the headline was broad confidence, but the structure underneath was much narrower and much stranger. Most people saw the stock market climbing and assumed that meant strength. They saw AI excitement, big tech profits, and the usual idea that America always finds a way forward. I understand why they saw it that way. Part of that story is real. New technologies do change the world. They create new winners, new wealth, and new bursts of optimism. But when I look at the full picture, I don't see a simple growth story. I see a pricing story. I see a debt story. I see a money story. That distinction is everything. If a stock goes up 15%, most people call that a gain. But a gain measured in a weakening unit is not the same thing as a true gain in buying power. If the measuring stick itself is shrinking, you can feel richer while becoming less safe. That is one of the oldest tricks markets play on people. They don't just move prices, they also change the meaning of those prices. I learned that lesson the hard way when I was young. In August of 1971, I was on the floor of the New York Stock Exchange when President Nixon ended the dollar's link to gold. At the time, I thought that was terrible. I thought if money was being devalued, stocks should collapse. I expected fear, I expected selling. Instead, the market rose. That moment stayed with me because it forced me to see something most people miss. What I missed then was simple. When you weaken money, financial assets often rise in money terms. They don't always rise because the world got healthier. Sometimes they rise because the unit you used to price them got weaker. It's like marking the height of a building with a rubber ruler. The number can change even if the building did not. Once I understood that, I started studying history much more seriously, and the same pattern kept showing up. When you hear people celebrate a record high, do you stop and ask what the measuring stick is worth? If you don't ask that question, you can mistake inflation for wealth and liquidity for strength. I've seen that confusion hurt people more than one market crash ever did, because it feels safe while the damage is still quiet. The reason I care so much about this now is that the debt cycle has moved into a dangerous part of the movie. Debt sounds technical, but the basic idea is simple. Credit gives people buying power today by pulling demand from tomorrow. That works well when the borrowed money creates enough income to pay it back. It works badly when debt grows faster than income. Then more and more cash has to go to interest and refinancing, and less is left for everything else. That squeeze is no longer theory. In fiscal year 2025, the U.S. government ran a deficit of about $1.8 trillion. In plain English, it spent far more than it took in. Total outlays were around $7 trillion, while revenues were about $5.2 trillion. At the same time, interest costs on the national debt reached roughly $970 billion. That is real money. That is not a rounding error. That is the system starting to feel the weight of its own promises. When I look at numbers like that, I don't focus first on whether the stock market can rally another 5%. I focus on who will fund the debt, at what interest rate, and with what confidence in the value of the currency they will be paid back in. That is where the real shift is happening. The crowd is watching earnings calls and chip demand. I'm watching the bond market, reserve behavior, and the quiet search for stores of wealth that do not depend on someone else's promise. That last point matters more than most people realize. A bond is a promise. cash in a bank is also, in a sense, a promise. Even money itself in the modern system is tied to debt. If you hold a treasury bond, you hold an obligation from a government to pay you in the future. If that government prints more money to make the payment easier, you may get paid back on time and still lose in real terms. That is why a safe asset can become unsafe without ever technically defaulting. People hear the word fiat and tune out, so I try to say it plainly. Fiat money is money because a government says it is money. It is not tied to a hard asset like gold in the old way. That does not make it fake. It does make it political. And when debt burdens get too large, politics starts leaning on money very hard. At that point, the real question stops being, will I get paid, and becomes, what will my payment actually buy? That is why I say the important move is happening somewhere else. It is happening in reserves, in central bank behavior, in the way countries think about trust, and in the way investors are starting to choose between paper claims and hard assets. The IMF's data showed the dollar's share of disclosed global foreign exchange reserves down near 56.8% at the end of 2025. Around the turn of the century, it was above 70%. That is not collapse, but it is a clear long trend. At the same time, central banks kept buying gold at levels that would have seemed unusual not long ago. In 2025, they bought about 863 tons. That is less than the extreme pace of the prior few years, but still historically high. And the message behind it matters more than the number. When official institutions that manage national reserves keep moving toward gold, they are telling you something about trust. They are telling you they want an asset that is no one else's liability. The surveys behind that move are just as revealing. A strong majority of central banks now expect gold to make up a larger share of reserves 5 years from now, and most expect the dollar's share to be lower. I pay attention when that many serious institutions lean in the same direction. Central banks do not buy gold because of social media excitement. They buy it because they are thinking about sanctions, reserve safety, inflation, and what kind of asset still works when politics turns rough. And politics has turned rough. In the last several years, the world has been reminded that foreign reserves can be frozen, capital can be blocked, trade can be weaponized, and payment systems can become tools of conflict. Once countries see that clearly, they start asking a simple question. If I save in another country's debt and one day that relationship breaks, how secure am I really? That question changes behavior. You don't need a dramatic headline every day. The behavior itself is the headline. You can see it in foreign demand for treasuries too. Japan is still a huge holder. The UK is large as well. But China's holdings are far below where they stood around a decade ago when they were well above $1 trillion. More recently, they have been closer to the 700 billion range. I don't treat that as one clean moral story. Countries shift for many reasons, but direction matters. And the direction tells me that the world is becoming less comfortable depending on one center of gravity. If this feels abstract, I want to make it human. I think about a careful saver who does almost everything right. Maybe it's a teacher, an engineer, or a small business owner. They put money into an index fund and a bond fund. They avoid silly speculation. They check their account and feel fine because the balance is higher than it was 3 years ago. But if the bond side is exposed to money losing value and the stock side is concentrated in a few expensive names, that person may be taking a different kind of risk than they think. That is the risk of mistaking the familiar for the safe. I'm not saying that saver is foolish. In many ways, that saver is more disciplined than most people in the market. I'm saying the environment changed. The old map is less reliable when debt is this large, politics is this divided, and reserve managers are quietly changing what they trust. If that sounds closer to your life than another daily stock headline, keep following this line of thought with me, because this is where quiet mistakes become expensive ones. Now, a fair objection comes up here. If I'm so worried about the debt and the currency, why not just say stocks are doomed? I don't say that because it would be too simple and too wrong. Businesses are real. Some companies have pricing power, strong balance sheets, and the ability to grow through inflation. Innovation is real too. AI is real. Productivity gains can be real. I'm not arguing against owning productive assets. I'm arguing against thinking a stock rally automatically means the system underneath is healthy. I'm also arguing against treating the stock market like one thing. That phrase is too blunt for a world this uneven. In one part of the market, liquidity is abundant, enthusiasm is high, and valuations are rich. In another part, households are strained, small businesses are squeezed, and financing costs bite. I've said many times that the economy is split. If you are in the top slice of wealth and own the right assets, the world can look fantastic. If you are lower down, it can feel very different. That split matters because bubbles often grow in islands first. The late 1920s had real innovation. So did the late 1990s. Railroads changed the world. The internet changed the world. That did not stop investors from overpaying for pieces of those revolutions. A great technology and a bad investment can exist at the same time. I try not to forget that. I don't short the future just because I see excitement. But I also don't assume that excitement cancels the old laws of price, debt, and human behavior. History has a strange way of looking new on the surface and familiar underneath. The clothes change, the devices change, the speed of information changes, the emotional patterns do not change much. When debt gets large, wealth gaps widen, politics hardens, and external rivalry grows, societies start making decisions under pressure. Pressure changes incentives. It changes what governments protect. It changes what investors call safe. It changes the line between economic policy and power politics. That is why I don't separate markets from geopolitics anymore. They are tied together now in a much tighter way. Trade is not just trade. It is also industrial policy, security policy, and supply chain policy. Ownership of debt is not just finance. It is also leverage. Reserve choices are not just accounting. They are trust decisions. A country that worries about sanctions, military conflict, or blocked access to capital will not think about reserves the same way a peaceful country in a stable order would. This is also why tariffs and trade fights are often misunderstood. People debate whether tariffs are good or bad as if that is the whole question. To me, they are often symptoms of deeper imbalances. One country produces and lends, another consumes and borrows. Over time, that creates trade gaps, capital flows, and strategic dependence. Then politics notices, then security notices, then the rules change. Tariffs can bring in some revenue, yes, but they are small compared with the scale of the debt problem. They don't solve the core imbalance. The core imbalance is that promises have grown faster than the system's ability to carry them comfortably. Once that happens, there are only a few ways out. You can cut spending, you can raise taxes, you can restructure debts, you can grow faster than expected, or you can print and repress, meaning you hold interest rates lower than they should be and let the currency do some of the adjustment. Usually countries use some mix of all of these. The public almost always prefers not to call it by its real name. Would your portfolio still feel safe if the asset you call safe can pay you back in weaker money year after year? That is the question I would put in front of every saver, every pension manager, and every government official right now. Because once you ask it honestly, you stop chasing labels and start studying mechanisms. So what happens next? I can see more than one path, and I always try to think in probabilities, not certainties. The first path is a messy but manageable adjustment. In that version, deficits stay large but not explosive. Growth holds up enough to buy time. AI helps productivity more than people expect, and the dollar weakens gradually rather than violently. Stocks can still do reasonably well in nominal terms in that world. Gold can do well too. The adjustment happens through quiet erosion rather than panic. The second path is the one I think many people are least prepared for because it feels comfortable while it is happening. In that version, The system muddles through by keeping liquidity abundant whenever stress appears. Bondholders get squeezed by inflation or low real yields. Real yield means what you earn after inflation. Asset prices may keep rising on paper, especially the assets closest to liquidity and excitement. People think they are winning, but their purchasing power does not improve much. It is a softer form of loss, and that is why it hides so well. The third path is the harder break. In that version, bond market buyers demand higher yields, fiscal deficits stay stubborn, politics blocks serious reform, and policymakers are forced into uglier trade-offs. Yields rise, financing costs bite, credit spreads widen. A credit spread is the extra interest weaker borrowers must pay over safer ones. Then the weakness that was hidden by easy money becomes visible. When that happens, the stock market story changes fast because nearly all asset prices are tied, one way or another, to credit conditions. I don't say that to scare people. Fear is not a strategy. I say it because preparation beats surprise. My own approach has never been about making one giant heroic bet. It has been about balance. I want to own productive assets. I want diversification across countries and asset classes. I want some exposure to assets that can hold value when debt assets are under pressure. And yes, in a world like this, I believe gold deserves a place in that mix, often something in the area of 10 to 15%, depending on the investor. That does not mean gold is magic. Gold does not give you earnings. It does not invent products. It does not grow like a great business. What it does is different. It sits outside the credit system more cleanly than most financial assets do. It has survived political regimes, currency resets, debt restructurings, and wars for a very long time. I don't love it because it is flashy. I love it because when confidence in paper claims weakens, gold does not need a board meeting, a bailout, or a promise. I also don't think people should swing from one extreme to another. The answer is not to dump every stock and hide in a bunker. That kind of thinking is just fear wearing a clever mask. The answer is to stop being one-dimensional. If your entire worldview depends on stock charts staying friendly and bond markets staying obedient, you are relying on a narrow set of conditions in a very wide and unstable world. I have never liked bets that require everything to go right. What I would do instead is very practical. I would think in real returns, not just nominal ones. Nominal means the number on the statement. Real means what that number can actually buy after inflation and taxes. I would ask which part of my portfolio depends on low rates and easy credit. I would ask how concentrated my equity exposure really is. I would ask whether I own any asset that could help me if trust in debt instruments weakens. Those are better questions than asking whether the S&P can finish the quarter green. I would also widen the dashboard I watch. I'd still watch earnings, of course, but I would watch Treasury yields more closely than most people do. I would watch the fiscal deficit, reserve trends, central bank gold buying, and market breadth. Breadth simply means how many stocks are actually participating in a move. If a market rises on the backs of a few giants while the foundation weakens, that tells me something important. If official institutions keep buying hard assets while the public keeps buying stories, that tells me something too. And let me ask you this. When the next big move comes, do you want to discover it from a headline after it has already hit your portfolio, or do you want to understand the pattern before it becomes obvious? That is why I keep coming back to these cycles. Not because I enjoy sounding gloomy. I don't. I do it because most painful outcomes begin as quiet trends that polite conversations treat as background noise. I have watched these patterns long enough to know that timing them perfectly is impossible. Markets can stay loud, narrow, and expensive for longer than people expect. Politicians can delay hard choices. Central banks can buy time. New technology can create real upside. All of that is true. But time bought is not the same as a problem solved. If the debt keeps growing, if the reserve mix keeps shifting, and if trust keeps thinning at the edges, then the pressure is still building whether the stock ticker smiles or not. So when I hear people say the market looks strong because stocks are up, I don't argue with the tape. I just ask a different question. Strong compared to what? Strong in what currency? Strong for whom? Strong for how long? Once you start asking those questions, the picture changes. You begin to see that the main event is not only about equities, it is about the changing relationship between debt, money, trust, and power. That is the shift I believe the crowd is missing. They are watching the bright screen while the reserve managers, the bond buyers, and the policymakers are reacting to a deeper reality. They are reacting to a world with too much debt, more conflict, thinner trust, and a growing need for stores of value that sit outside the usual web of promises. Stocks may still rise. Some of them may rise a lot, but if you only watch that, you may miss the thing that will matter more over the next decade. I've lived long enough in markets to know that what looks boring at first usually ends up being the part that changes everything. The crowd loves price action. I respect it, but I don't worship it. I watch the plumbing. I watch the incentives. I watch who is quietly changing behavior before the language changes in public. That is where the real clues usually are. And right now, the clue is simple. The world is not just repricing stocks. It is repricing trust in debt, trust in currencies, and trust in the old financial order. If you understand that, you don't have to panic, but you do have to prepare. Because in every cycle, the people who only watch what is loud are the last ones